What do you make of these discussions? It looks like we could be moving towards an agreement. Everybody's expecting something by the midnight hour, as it were, which we're not quite sure when that's going to be, but June the 1st is what Janet Yellen is saying. And there's a chance, though, that it may not happen. What's the deal?
Yeah, there's certainly a lot of moving parts, and it's highly unpredictable at the moment. I think the fact that talks are progressing, especially that staff are discussing that the meeting that was planned for the end of last week was postponed, shows that there is some progress being made. But I think the key factor here is that they are running out of time, so to speak. There's just not that many days left to negotiate, and it's not clear exactly what the X date will be. There's a lot of focus on Treasury redemptions and Treasury tax revenues, and the date floats around a little bit, but most recent data looks like it could be actually pulled a bit forward, closer to maybe that June 1 date. Versus the mid-June, which I think was initially expected as of last week. So there is just not that much time, and given, I think, as you mentioned, how far apart they are, even if they make progress, it's not yet clear they'll be able to get to a deal by that date. And so a better case scenario, best case scenario, as of now, looks to be that they form some sort of agreement to postpone it maybe a month, maybe 2 months, to continue negotiations. Yeah. But it will likely go down to the wire. They are quite far apart.
Alex, is this just politicking? Is this noise when it comes to investors here right now? I mean, people say, look, the playbook could be like what we saw back in 2011. Is that the right sort of way to play it?
That's one thing that we struggle with, and we certainly get a lot of those questions from clients because we don't have a precedent to go by. We have 2011 when it went down to the wire, and there we saw equities were down quite a bit. We saw Treasuries rallied. We saw the dollar rallied. So it looked like a flight to safety, a flight to the dollar. It's just not clear if that will happen this time because the global backdrop certainly was different. You had the Eurozone debt crisis at that time that was really putting pressure on equities. And right now, with this being really kind of an acute U.S. issue, it's not clear that you'll see flows necessarily into the dollar, necessarily into Treasuries. And so it's really, really difficult because there's not a clear playbook given how unprecedented this is if they do go past the X date and you do see a technical default.
Yeah.
Alex, the investment advice is what then, given all that?
So given that we expect continued volatility, we are recommending hedging downside from an equities perspective, especially given that we have valuations are still expensive. Equities have rallied a lot more than anyone would have expected this year, just given the backdrop of rate hikes and inflation and recession risk. So we are recommending hedging, and we are recommending Treasuries. We do think, just from a fundamental perspective, that regardless of what happens around that date, we are still looking at the amount of rate hikes that we've seen, still with inflationary pressures, maybe even putting pressure on the Fed for further rate hikes, likely causing a slowdown, likely causing a recession. And we are still having to go by that old playbook. And if we do see volatility increase, we do think that there could still be some flight to safe haven assets, and that really only leaves Treasuries. So we do think that even though there's issues around certain dates of maturities, that we still see flows into Treasuries, and we should still see yields fall over the course of the year.
Yeah. There are concerns of a potential credit crunch. I'm just wondering, where do you still see value in fixed income right now? And what do the macro conditions tell you about credit?
We are seeing credit growth slow. I think perhaps not maybe as much as initially would have been expected, given the stress that we're seeing amongst banks. That, though, for us really weighs on our macro view. As we see credit growth slow, when we look at the multiplier from credit growth to GDP growth, we do think it'll be a key factor in terms of slowing growth over the course of this year. Data's still been mixed. It's still been, I think, slightly stronger than expected. Inflation is still presenting some upwards pressure, but we think that the credit crunch that we're seeing, I don't know if I'd call it a crunch, but we are seeing a slowdown in the flow of credit, tighter lending standards, and that broadly should weigh on growth as we go into this year, leading to what we think will be a recession and a disinflationary recession at that. So that, again, factors into our Treasury call, our broad fixed income call.